Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. We have a lot of volatility still in the markets and a lot of volatility and bearishness still to come overall, but GameStop is still steady. It looks, though, on GameStop like we may have an interesting signal from Ryan Cohen and some continued green lights across our board on all of our volatility cycle, or I should say volatility phase checklists. So let's take a look at those today on our breakdown. That's what we're going to be taking a look at. Before we get started, of course, we are always starting with our gratitude. So gratitude for today's newsletter. Sponsoring today's newsletter is Kurt Lesko, aka Short Fridays. Thank you very much, my friend, for your support, as well as our monthly contributors, Dat Scruffdo, Ken Wedmerlin, and Not Medical Advice, who generously offset some of my data expenses on a regular basis. Thank you very much to everyone who has contributed in the past and will contribute going forward. Very much appreciated. So let's start here today, right? One of the reasons I love Superstonk, right? Superstonk is an excellent conduit for people who can be surprisingly perspicuous, perhaps not surprisingly, but incredibly perspicuous with respect to memes. I think that is part of the strength of the Superstonk front page. So we got this tweet. We got this tweet here. I guess this was 2 days ago. Was this on the 7th, I think, from Ryan Cohen saying they better not put tariffs on gefilte fish. Okay, so on the one hand, seems like a fun joke. It's referencing tariffs, right? Okay, something about Ryan Cohen. He's back to memeing, but really, what's the significance going on here? And it doesn't seem like we had anything speculating too much on this until yesterday. Somebody noticed, of course, Ryan Cohen went ahead and deleted his gefilte fish tweet. All right. The last time that Ryan Cohen deleted a tweet was when he tweeted YOLO on October 25th. So let's go take a look at our charts. What happened back on October 25th? We can take a look right here. This was the day before. This was our last trading day before we got our first price up at the very beginning of our next volatility phase, of our previous volatility phase. So he tweeted YOLO on Friday the 25th and then deleted it. And then that very next Monday, we had that big leg up. We had that very big leg up into just before National Cat Day, which was on the 29th. So a lot of people were looking to the 29th. 25th, we get a bit from Ryan Cohen. Let's see. I think we got maybe a PMO cross right about there. Just the day, actually 2 days before the PMO cross actually occurred. How about that? The PMO cross actually occurred down on the 29th of October. So PMO cross we got actually on October 29th, but just 2 trading days before that on the 25th, we get a YOLO tweet. And then the really big price up shot up from like 20 something to 23, I guess 23 we topped out on the day. And of course, on this move, we topped out at around 24.50. So just below 25, very close to where we topped out this time. Right, although we do have some convergence here. Oh, I'm sorry, I forgot to share this tab. Right here, October 25th, right? Into here. So, okay, right, so this is the last time we saw a tweet like this. The last time, I should say, Ryan Cohen deleted a tweet. So then we have, of course, somebody over on Superstonk was able to find out, right, that this appears to be a reference to the movie Rocket Man from 1997. And there's a whole bit about there's an ape, right? There's a monkey in the rocket ship, and there's a painting of like Michelangelo and stuff like that. So, all right, a rocket ship to Mars, where apparently the ape on this rocket who's riding the rocket with everybody is a fan of gefilte fish. So something about this seems to suggest, hey, we're inbound maybe for a phenomenon that's quite similar to what we saw take place right at the beginning of our volatility phase, our last volatility phase at the end of October and going into November. So, okay, why does this seem to hold water? Why do I think that this is a very likely interpretation? Well, as we've talked about yesterday, we're meeting all of our major criteria here for what the beginning of a GameStop volatility phase is going to look like. And heading into today, we see this is indeed the case, right? So I won't go through absolutely everything here, but very importantly, we still see volatility up. Trading volume is up, right? Came down a little bit. We did see a little bit of short liquidity, right? So normally we're looking at volatility, we're looking at decreased short liquidity. So when lending liquidity comes down, volatility goes up, which is, we have been seeing this. And that begins, right? That begins the beginning of a GameStop volatility phase, because when GameStop gets volatile, the price goes up, right? It's not like SPY. SPY volatility up, price goes down. GameStop volatility up, price goes up. So interestingly, and this is really what I want to point out here, what I want to hone in on here. Yesterday, we got something of a price down, right? We did seem to get dragged down potentially by the market. We had a recovery on Monday, which seemed to push our price up. And then, or I should say on Friday, we had a bit of a, no, on Monday, excuse me, today's Wednesday. We had a price back up on Monday in the market. We recovered, right, once institutions were able to meet margin calls, maybe set up, rebalance their positions. Yesterday, we moved back down amid this volatility, right? Very early, we were up, and then we came back down. GameStop opened right close to that $25 call wall, and then we started to move down. Interestingly, we saw a very large expansion out of, right, overnight in GameStop liquidity just in time for market open. So we're still looking at bearishness broadly in SPY. In fact, this is indeed some of the bearish that I've ever seen this going forward. April OPEX looks to be massive. It is a massive put gamma expiry. An incredible number of puts were opened for this expiry yesterday, during this move yesterday, right? So as we moved up, as the price moved back up and volatility cooled off for a bit, there was a lot of put re-upping targeted right for April 17th. So it seems to be the market is thinking, okay, market volatility is definitely still going to be up, which means we're likely going to be pricing down there. But is that going to affect us going into April 17th with respect to GameStop? Well, we did have that liquidity increase very briefly yesterday, which I think is really what was responsible for us moving down. But we saw a very large XRT creation order come through, 2.45 million shares. XRT shares available to borrow right in the opening minutes of the day shot up, right? So they were overnight, they were at zero. XRT shares got down to zero on Monday. Tuesday, they moved up to 450,000. And then right at market open, they moved up to 1.3 million. GameStop shares to borrow at the same time increased right up to that 2.3 million number, I should say, right here. So basically right after open, after a few hours, right, moved up to 2.2 and 2.3 million. So it does look like, and this is just using interactive brokers as a proxy here, it does look like those XRT shares that were created immediately supplied some liquidity to GameStop. IV fell off a bit. It's still not down to liquidity cycle or liquidity phase levels. But it did increase, and we do still see that there's that number of shares available for direct shorting. However, very intriguingly, is that another almost 4 million shares were created last night on XRT. However, borrowing liquidity has shot down right before the pre-market open. Actually, I think right around the time we got the announcement that China is going to boost its tariffs again against the US, shot down by over 90%. So even though we see shares outstanding increasing, we see shares actually available to borrow. So lending liquidity on XRT is going down. So very interestingly, and I would really encourage you to go ahead and check out Richard Newton's videos on this. He's done a really excellent job pointing out that there's this interesting moment where when we have ETF lending liquidity go down, but shares outstanding go up, when we see these two things take place, this is generally indicative of an upcoming volatile and large upward move in GameStop. So he identified something like this taking place, for example, I believe back in April of 2024, and going back to the 2021 event. Now, I'm not necessarily suggesting that what we're looking at here going into April, May, and June, going into this volatility cycle, is necessarily going to look like April, May, June 2024, or what occurred in 2021. But this type of movement is suggestive of a larger upward move in GameStop. Obviously, there were a very large number of other factors that influenced that crazy, huge, upward, volatile, dynamic move in GameStop. Even last year, right? A lot of what Roaring Kitty did, I think, or the significance, right, of Roaring Kitty coming back, his importance to retail investors, and encouraging renewed interest in GameStop, and then, of course, what he was able to pull off with his options trades as well, played a very large role in why we went as high as we did. But this does seem to be an important underlying factor in a generally large GameStop price up. So that's highly suggestive that we are continuing on our trajectory towards a large price up. So combine this signal from Ryan Cohen plus all of these other factors we're looking at, elevated IV. We don't have any swaps coming up that seem to get in our way, besides some potential for Chewy swaps coming up, which Metro Ballin has pointed out here, maybe correlated with GME price up as well. So yeah, in fact, Richard probably pointing out over on his videos today that we are seeing not only this type of liquidity, I should say increase in shares outstanding, not liquidity, but shares outstanding, increase in XRT, but we're seeing it actually across the major ETFs that contain GameStop, despite the fact that for the past 2 days, all of them except our XRT have remained conspicuously inactive. So very interesting there. I really, really encourage you to go check out Richard Newton's video, certainly today, but his videos on this topic in particular. Right, so as I said, we did come down a little bit, but our IV levels are staying elevated. See this in our 10-day mean. So this is the 10-day average of our 30-day forward-looking implied volatility. We can see here, right? I mean, they've come down a bit. I think, yeah, early to mid-May, around May OPEX, we've had a bit of a decrease. June, July, and then October, we've had some. June is still up, but yeah, I would say May has come down a bit. April is still volatile. Early May still very high. This week certainly got even higher. So that's brought our composite levels down a little bit. We kind of dipped a little bit under 100 there. What are we looking at in terms of open? Yeah, we're kind of back down just about 99, slightly under 99 if we're looking at the Schwab composite value. This may go back up, certainly, depending on, right, well, yeah, we did shoot above that a little bit. No, we stuck around 99 after hours. All right, so it's come down a little bit, but it's still elevated versus our baseline. And that's really, it's hard to visualize that kind of when you're looking at the Schwab value. If you kind of zoom out, it's very nicely visual. You can visualize it very easily when you're zooming in on that 10-day mean. So it's still elevated. We're still looking at that likely as a result of the liquidity crunch here, right? Just as we saw on our technicals, probably bouncing off this level here, come back down a little bit. There's potential for a move, this bigger move up here. So I want to talk about the potential for that. I still think, I'm still iterating that I believe a bigger move up into the 27 or 2750 area is going to require some sort of major settlement event. It's going to require something external to move us out of this territory. Technicals do look good in terms of that type of move unfolding. However, if we go and look at our options data, I want to point out a few things that are convincing me that this week, although we can see plenty of upward volatility, I think we can move back, like I said, into the $25 area. If we're going to move through $25 as a call wall, that's going to require an external move. And I think based on what I'm seeing, it's probably something targeted for next week, as I understand a market maker incentive to try to control the price below there. So we'll hop in, take a look at that, right? We did get, as we pointed out yesterday's video, we got that PMO cross. Options activity a little bit skewed bearish yesterday. Makes sense based on our price action. We did see an increase in the puts for this week, the short-term puts for this week at $22. Not much activity elsewhere. Some mixed calls up at 30, but that's about it. The really interesting changes, I think, for me are the 17th. And so what I see here emerging in our total OI figures, for 417 OPEX has to do with the shift in total OI on the call side. So if we look at this week, right, we look at this week, $25 is roughly equivalent to the size of the OI position at 30. It is a larger, therefore, well, yes, in the short term, it is a larger gamma position right now based on how closely we are, how close our price is to this level. What that means is, right, disproportionately, the profitability of the options market maker on this week is skewed toward keeping that $25 position out of the money. We have a lot of our calls. That's like, 15% of our total call OI is at that strike. So the market maker is very motivated to keep us out of the money there. Max Payne sitting at around 23. If we look, because we also have that very large put position at 22, and you'll notice right yesterday there was a large expansion of trader long puts at that level. Right, the market maker is incentivized also to keep the 22 position. Let's see, the calls in the money. We have very little in the way of calls at 22, but this huge put position. So the market maker is going to benefit from keeping 22 and 22.5. I mean, 22.5 is about even, but keep the 22s out of the money to have all those puts that they just sold at that strike expire worthless. So 23 right standing out as Max Payne, but this week, because 25 is so big, I still think the market maker is going to invest some effort, even if it's interventionary, even if it's a little mechanics English, a little musical chairs, to try to keep 25 out of the money. Now, see, that's going to change next week because $30 is weighted a lot more heavily with respect to our total call OI versus 25. So 25 is still big. I'm sure the market maker would still like to have that position out of the money next week, but it's much less critical if the market maker uses that or uses that. It's much less critical if that position closes in the money for the market maker's optimum profitability. What could happen too is if we shoot up through here and these 25s go in the money like we've seen before, and that is what it took. If we bump back over to our daily tab here, in order for us to move to 25, right? So last time around, we went up, we kissed 25, got really close for cat day. We traded back down a little bit. We settled back down into the 22s or such. Got actually dipped all the way down into the upper 21s, just below 22. And then we started our really big move across a few days up back into that kind of right all the way to 27. Right, 27, 28 we went up to, and then we settled down, touched back to 25, and then did our next leg up where we pushed through 30, all the way to 32 just before Thanksgiving. Okay, so we really exploded up through that level. And okay, so how does, let's say, exploding up through that level, even if it involves, delaying some settlement of shares or something like that, of delivery on obligations, why would the market maker be incentivized to delay this a bit and then have it explode? Well, if you're positioned such that, moving into this upper bracket seems like it's going to be an inevitability, if you can delay some of the settlement, if you can delay some meeting some obligations, then, and you explode up through that level rather than trickle across it, you're going to encourage some options euphoria. You're going to encourage some call buying euphoria. And so a lot of new OI, just like we saw back here, is going to start to insert itself in the upper 20s, around 30, and above 30, right? Especially above 30. 30 is going to be a massive, I really think this is a candidate for a call wall move up next week. It's going to be a massive position that is going to be much easier to use as a barrier via hedging practice, via hedging behavior, with respect to keeping those options out of the money, with keeping it and everything above that out of the money. So retail buyers, right, of course, retail will see this volatility come in and will want to trade very far out of the money stuff, largely with respect to, this is MOAS, as the prophecies foretold. I can buy $65 calls or $40 calls for only $50, but if I buy something in the money, that's $500 a call. So it's cheaper for me, to go and buy the out of the money call. I'll just dump my money into these, right? So that's money just directly into the market maker's pocket. That's into Wolverine Trading's pocket. That's exactly what that move is. Unless you're super skilled, unless you're a gunslinger and you can hot potato these things, like, you're going to lose, right? Because that's structurally in your favor, or out of your favor, and in the dealer's favor as your trader. So I think, right, based on what we're seeing in terms of contextual stuff, I think this type of move up, a big move up in GameStop, in the next week or so, basically into next week sometime, I think is something that could take place. What we're seeing with liquidity right now, what we're seeing with ETFs, what we see taking place across a number of our different indicators, what we see now with PMO, right, with Ryan Cohen's tweets, seems like something like this that we saw back in early November can take place. Now, if that is going to occur, I think that's how the market maker would prefer to have it unfold. Whether the options market maker actually has control over something like that, I don't know. But I do notice some very deep similarities with respect to, I mean, even to price points, right? With respect to how our option structure looked back then. You can go read my articles back then too. We can go take a look at the data. Maybe we can look at that on Friday at our live stream. We can do some comparison, but very similar environment, very similar type structuring in our options, in our OI along the options chain. So okay. So then, all right, what does that mean with respect to our gamma setup and our intraday trading? I do want to point out that I think we have a possibility of moving down. We could do this. There is the liquidity to force something like this to happen. We have over 2 million shares available to borrow, which can be used for direct shorting. What could happen is we could see an institution come out and then try to push GameStop down toward 22, try into these kind of upper 21s, largely because we do have a very large trader long put position there. If we see that occur, and I want to point this out now, we've seen this occur in the past. If we see this occur and 22 kind of dips right out of the money, that's going to set GameStop up for a slingshot back up toward 25. So what dynamics are at play that are making me say that? So in order to understand that, right, this is where the characteristics of those OI positions are coming in. So $22, right, we look at this, you go, oh, okay, well, if we go there, we kind of put gamma ramp down to maybe 21 or 20, maybe down here. No. So 2150 is actually a trader short put position that hasn't changed very much over the past few days. Remember calling this out. What that means is that the typical gamma exposure orientation of the trader and the market maker, the dealer, are flipped. So if it's trader short puts, it's dealer long puts. That means trader trader positive gamma and dealer negative gamma. Dealer negative gamma is going to be hedged by buying shares, so the dealer can have positive gamma exposure, or buying shares to hedge the delta and hedge the gamma, right? So the trader or the dealer will buy shares in order to remain delta and gamma neutral with respect to that position, and therefore that's going to offer some hedging support intraday rather than sympathy with a move to the downside. 22 is going to be a more volatile move. If we see that position realize, if we start to move down pretty hard, there's going to be sympathetic share selling or shorting with respect to that position, since that is what is typical of what we expect from trader and dealer orientation, what's typically indicated by charts like this. So the traders there have a lot, actually, right? Over 10,000 contracts at 22 long puts. So the dealer is going to sell shares or short shares moving into that position as we move down. So that will build up some momentum, could carry us, but then we'd kind of move into that hedging resistance at 2150. That's kind of sneaky hedging resistance there, or I should say support there, which would then move us back up. As we move back up, right, then the dealer becomes a sympathetic buyer as we move through that 22 position, can build up some momentum. Then we move back here, right? We move back into this call gamma ramp that we talked about before, which we've run a couple times now, 1 or 2 times. And then we move back through the 23, 2350, and 24 position, which is this kind of composite call GEX dominant position, and then either hit into the 25 call wall or get slowed down on the way there by this 2450 kind of hedging dead zone, right? And we also have a hedging dead zone right above, probably not enough to pull us up through there, right? I'm iterating this point again. I don't think there's enough hedging pull, right, based on an options movement alone to move up through that $25 call wall this week. So we need to see something unexpected, a big move, kind of a big external buying force come in and really move us through that position, which I think is, based on how our structure is, something that's more likely to occur next week rather than this week, but not sure. So just framing that in terms of possibilities and what I see likely based on this type of structure. So if that occurs, right, another reason, right, we would move if we move and 2150, 22 is out of the money. With respect to calls, if these 22 puts move into the money, right, that's going to be something like 98 or 99% of our call OI is going to be out of the money. Maybe 98, 97. Yeah, because this 20 position is decently sized, right? And a huge amount of our puts will be in the money at that point at 22, which, as we talked about, the dealer is incentivized for those to expire out of the money. So we'd get some reversal. I think we'd get a pretty strong reversal back to the upside if we do see that move materialize. We'd have the slingshot at the bottom there, and right, supported 2150, volatility back to the upside if we move through 22. And then a call gamma ramp to take us back to 2450, 25, where then we'd kind of settle back to the downside. So seems a probable move if we see that take place. Not saying that necessarily is going to take place, but if we do see it, that is what I think the price action dynamic will emerge as, and how I expect options traders would also play that. Okay. So that's what's on the docket today. Our longer signals, our deeper signals are still looking very good. I think these are the scenarios that I think are most likely to play out based on what I've seen so far with respect to our structure. I think probably still a finish inside 25 this week again, unless there's one of these kind of something swap related that's hard for me to keep my finger on, or something there's some crazy margin call that occurs that just gets erupted onto the tape or something like that. Something that I'm not necessarily in a position to track or be able to predict. Something like that can happen, in which case we might make that move through 25 sooner. But certainly, because I think the options market maker is incentivized to keep that structurally this week, more incentivized to keep the $25 position out of the money versus next week. I think we have a better chance of moving into that $25 to $30 trading bracket next week than we do this week. So those are my thoughts. That's what I'm seeing right now. It's just, this is must-watch TV as far as I'm concerned. Going right. I mean, actually, I think speaking of everything going on with Trump, right? One of Trump's favorite quotes: something occurs. That's he has an eye for it, right? He says, "That's great television," right? one of the interesting things for him to say. So, what I would certainly say right now is what's going on with GameStop, what's going on with the market, tariffs, whatever you have, man, that's great television. So yeah, definitely. Good luck out there, everybody. As always, always happy to get your comments, questions, concerns. Yeah, always happy to hear from you. We'll see you for our next video breakdown tomorrow. So thanks very much.